Hello friends, Stacy Anfinson here with your TAR Report market update for February 14th. Today we're going to have a little QA with me. I actually have a Q&A with myself because going through all this data, I'm curious as to why things happen. So I'm going to pretend that you asked me these questions, but I really ask these questions and I'm going to try and answer them for you because I know your questions are my questions. So, three questions. We're going to go, why were January closed sales, resale listings down 30%? The national media is bombarding us with stories of house price crashes in other markets. Is that happening here? End of month inventory in January is up 302%. That's a pretty big number. Is that a bad thing? So let's dig into that. All right, what we have here is a graph of January closed listings going back to 2014. The yellow is that number. The blue is my favorite graph of the last couple months. That's the national average for a 30-year fixed rate mortgage. And you can see that in 2014, there's really very much a stable interest rate environment between 2014 and then 2020. And then coming out of COVID, things just really kind of bottomed out. And you can see as this number goes down, these three numbers go up. And then as this number goes up, these three numbers go down. So I'm going to say that our culprit for the big decrease in January closed listings, both in resale and the overall market, is due to increasing mortgage rates. Now I need you to pay attention with me on this one. This is a little busy, but I think it's pretty good. So this is the percentage change in closed listings compared to the same month prior year, and then the national average once again for that 30-year fixed rate mortgage by month. So we're going to go back to January of 2022. This is January of 2023. The gray is the percentage change in closed listings. So if you look at this, minus 10% in January of 2022, that was compared to January of 2021. So you see we're all in negative territory. Not too bad in terms of down 10% to 16. That obviously, if you're in the business, that was not good. But really where the big jump started when we went from 5% in August up to 7% in October. All this level of interest rate produced big decreases, minus 28, minus 34, minus 34, minus 30. So once again, the culprit, little CSI here, the culprit is increasing mortgage interest rates. And I think it's pretty clear that that is the reason for what's going on. Now let's talk about our house pricing crashes, or supposedly. Some you've read some of the articles I have. So this is really what happened in our market last year, the gold bars, the average sales price, and then the orange line is the average list price of the pending listings. And the reason I put this in there is it can be a predictor of future house price metric increases or decreases. And you can see last year they just the bubble's obvious. We've been over that before, from January to July, boom, tremendous increases in all of those. But really what I want to focus on is what happened between October and November. Actually, between September and January, pretty much had a fairly stable pricing environment. The close metric in that September was 492, and then January was 493.6. That peak in December was probably due to mortgage rate levels in October. Remember now that this kicked in, mortgage interest rates crested above 7 in November, and so we went from 495 down to 493. But I think if you were to look at this period between September and January, there's no way in the world that you can infer that we have a house price crash going on in our market. Last thing we're going to talk about is end of month inventory, and this is just crazy in terms of where it was end of month January a year ago. Only 861 listings on the market. January this year, 3462. So it's good for buyers in this market with 861. They didn't have any choices, and that's why you had that silent auction-based pricing market and 35 offers and all that stuff going on that you experienced during the first quarter of last year. This is certainly more healthy, and when you look from September to January, that really is a normalization of our bell curve in terms of inventory decreasing in the fourth quarter compared to where it was in the second quarter. Now, a couple things we want to talk about in terms of a floor for house prices. If this is months of housing supply, and if you go all the way back to 2014, this is really a balanced market. In 2015, we had a balanced market. And in my world, a undersupply market is noted at 3 months or less. And you can see essentially from 2016 all the way to 2023, we've had an undersupply of housing. So it's really tough. This provides a floor for house prices in terms of it still very much favors the sellers and not the buyers. And then you see 2022 had less than a month, and 2021 we had a month. So these two were just historically lows. But this really is something in terms of I view as a positive. Whenever you have a months of housing supply that is in the undersupplied territory, that is favorable for the sellers, and certainly not an environment where house prices will decrease. Now, here's the other one. I love this graph. First off, I created it, but second off, I think it's really illustrative about what's going on. The blue thing is the percentage change in RDU population growth, and you can see consistently 5% across the board. This is down a little bit. Not sure why that's the case, but let's look at the gold line in comparison to that. That's the percentage change in TMLS houses listed. So you can see that inventory pretty much kept up with population growth. 2014, 2015, 2016. And really, if you go back to that last graph, you can see this is where the undersupply really starts to kick in when you have population growth like this and listings only added at this percentage. And then you look at 2018, 5% population growth. We're flat on that. And then this is, once again, that mouth of the alligator jaw showing up here. We've been negative in terms of houses listed during 2021, 2022, and in January of 2023, yet we still have inbound population growth. So once again, that is another floor for house prices. And once again, you do not see this in markets where house prices are decelerating. Have a little, we'll take the Wayback Machine. The last time mortgage rates crested 7% prior to November of last year was March of 2002. Couple fun facts for you. The average price back then was $200,000. Today it's $493,600. Average square footage, which kind of amazed me, was at 1952. Today it's at 2063. Average sales price per square foot was at 94. And a lot of you have experienced this. If you had your money in the stock market, Dow Jones Industrial Average at 9,600. Today is at 34,246. All right, how about some answers? I know that you are following along and paying attention, but just to kind of reinforce what we went over. So explain the decrease in January closed listings. To me, it's open and shut, increasing mortgage rates in November. The second bullet point is our house prices crashing. In my opinion, they were stable during the months of fourth quarter. Months of housing supply is still in undersupply territory. We have net population growth, which exceeds inventory growth. And then end of month inventory increase, a good thing or bad thing? Well, while January 2023 was up 302% compared to January of 2022, it's down 50% compared to where it was in January of 2014. So we still have a long, long ways to go before we can catch up on that. So I hope you all paid attention. I know you did, because the people that listen to this are really astute about wanting to know what's going on in the market. So I'm sure those questions have been asked to you. So hopefully you can view this report and get the word out, because the biggest challenge that we have is going up against all the national media narratives about what is going on in the marketplace. So I hope you enjoyed it. Here's my contact information. If you like this video, please thumbs up. If you haven't subscribed to this, please do, and we'll see you later.